Consolidation of a majority-owned subsidiary, Part 2. This is Ken Boyd, the owner of St. Louis Test Preparation. Here's our Facebook page, email and phone number, and the source of this presentation was taken from Advanced Accounting text from McGraw-Hill, Chapter 5. Just to quickly review, we talked about in the last video, number 12, the differential and why we might have a differential. It's the difference between fair market value and book value of specific assets, or it may be that there is goodwill that should be on the books as an asset on the balance sheet that isn't yet recorded. We also talked about the idea of a parent firm, Levi's, buying an 80% interest in Hollywood, a subsidiary. So we have a controlling interest of 80%, a non-controlling interest of 20%. If I jump back over to Excel, we had left off on this calculation of a differential. We had the fair value of the assets, which is the $300,000 book value that was acquired, the common stock and the retained earnings, plus $75,000 to account for the fair value of specific assets that was more than book value, totaling $75,000. That's how we got $375,000. We found out that the purchase price that Levi's paid for 80% plus the value of the non-controlling interest was $387,500. That's how we got this number, the fair value of the consideration. And then we had the book value of the assets acquired, the common stock, and the retained earnings. So the difference between book value and fair value is $75,000. The difference between the fair value and the amount you paid over fair value is $12,500. Let's now look at what happens when we go and do a consolidation. Here's Levi's books. Here's Hollywood, the subsidiaries books, and this is the balance sheet immediately after consolidation. You'll see that we have an asset, investment in Hollywood jeans, on Levi's books. The rest is pretty self-explanatory. Let's look, though, at the two elimination entries that end up in these columns. You'll notice that some of the entries are in blue and some are in brown to help you distinguish. The first thing we're going to do is eliminate the investment account balance and establish a non-controlling interest. That non-controlling interest being the 20%. Here's the common stock and the retained earnings of Hollywood jeans that we take off the books. That comes from right here in the stockholders' equity. We have a differential of $87,500 that we calculated over here as the difference between the fair value of the assets and the book value of the assets acquired, $300. That's where we get the $87,500 that's over here. We're debiting that. We're removing the investment in Hollywood jeans that we talked about here when we made a journal entry. When Levi's made a journal entry to purchase the assets, they debited an account called investment in Hollywood jeans. And in this entry, we're crediting to bring it to zero. And then we have the non-controlling interest that was given to us in the question, $77,500. So you can see all these adjustments up here. Here's the investment in Hollywood jeans credit that brings the account to zero. Here's the differential in blue. Here's the common stock and retained earnings debits to remove the balances, both in blue. So that entry was done to eliminate the investment balance, which we did by crediting, and to establish the non-controlling interest that we did also by crediting. We then have to take that differential that we just debited of $87,500, and we're going to credit to bring that account, the differential, to zero. And our debits to replace it is going to be two things: the fair value of the specific assets that we're adding to the consolidated books and the goodwill that we talked about. All this information happens back over here. Here's our total differential. Here's the fair value of the specific assets that we're going to see debited in that second entry that's in brown. And finally, the goodwill is this amount, the difference between the fair value of the consideration and the fair value of the net assets, which is the 300 plus the 75,000 fair value over book value. Goodwill, all these specific assets and their higher fair values. That's what's going on the debit side of this journal entry, and we're going to credit the differential, which is going to bring the account to 0. So looking up in the elimination section of this balance sheet, we're debiting inventory, we're debiting land, we're debiting goodwill, we're debiting building and equipment. And what we're crediting is the differential, 87,500. That 77.5 right here should be in blue because that was the other entry. What we'll see is that the debits and the credits in total balance. The debits total 475 and so do the credits, and I always suggest that you do that when you're making journal entries, because if the debits and credits equal, you know that you don't have an entry that's out of balance. So what we just did was looked at a consolidated balance sheet for Levi, the parent, and Hollywood, the subsidiary. We made debit and credit entries to do an elimination. Those represented taking the investment balance off the books, creating a non-controlling interest. We then took the fair value of specific assets over book value. We created some goodwill based on the amount paid over fair value, and we took the differential off the books that we had put on the books with a debit here. We took it off the books with a credit here. That's the end of Advanced Accounting 12 Part 2. You can see hour-long topics which you can contact us for in a variety of accounting topics if you'd like to see more than just the 10 minutes. Our YouTube channel, Ken Boyd STL, all one word. For individual one-on-one tutoring using GoToMeeting.com and small group live chat sessions, here's our website, our email address, and our phone number. Thanks very much, and we'll see you next time.